When you think of Intel, do you still see a fading giant struggling with foundry losses and losing ground to TSMC? 2 years ago, Wall Street was betting on whether Intel would become the next Kodak or Nokia. But if you're still looking at Intel through that lens, then you might be missing one of the most aggressive structural reversals in the equity markets. By April 2026, Intel stock has hit a 5-year high, surging 178% over the past year. This isn't just a legacy company catching a bid. It's a fundamental re-rating. We're seeing a historic shift where Intel's fiercest rivals are becoming its biggest clients. Why are Google, NVIDIA, and Tesla suddenly funneling billions into Intel's ecosystem? Is the 18A process truly ready to challenge TSMC's hegemony, or is this a temporary reprieve fueled by a global capacity crunch? Today, we're breaking down the 3 trump cards that are rewriting Intel's future. My name is Phoebe, and you're watching TradingKey. The anchor for Google's AI roadmap. First, let's talk about the structural partnership between Google and Intel. Many retail investors see Google's commitment to Intel Xeon processors as a routine hardware purchase, but they're missing the second derivative, the structural migration of compute demand. As AI evolves from content generation to AI agents, the compute bottleneck is shifting. While GPUs handle the brute force training, the CPU acts as the general manager of the system that performs logic, decryption, and system scheduling. Even NVIDIA's own leadership has warned of a CPU bottleneck in scaling AI systems. Google is locking in long-term contracts for the Xeon 6 processors because high-end CPU capacity is becoming a scarce resource. According to INTC, CoWoS advanced packaging utilization hit 100% in late 2025, pushing CPU lead times from 10 weeks to over 24 weeks. While Google is developing its own ARM-based Axion chips, they're using Intel as a strategic buffer to survive the current compute famine. For Intel, this isn't just revenue, it is capacity pricing power. With 2026 production already largely pre-sold, Intel is effectively collecting a compute tax on the entire AI industry. NVIDIA's $5 billion insurance policy. The second is the most surprising. NVIDIA, Intel's primary rival in the data center, has invested $5 billion for a stake in the company. Why would Jensen Huang hand such an opportunity to his competitor? This is a masterclass in supply chain de-risking. By investing in Intel, NVIDIA is placing a seal of approval on Intel's 18A process. If the world's most demanding chip designer is willing to put $5 billion on the line, it acts as a massive credibility boost for other hesitant institutional clients. Furthermore, this provides NVIDIA with a political insurance policy. Amidst geopolitical uncertainty, NVIDIA cannot leave its entire future in a single basket. By supporting Intel's domestic manufacturing, they are buying a seat at the table of US-made silicon. For Intel, this $5 billion infusion, combined with the US CHIPS Act support, has effectively resuscitated its cash flow, turning a suffocating debt load into a war chest for R&D. Scaling 2nm with Tesla and SpaceX. Finally, let's look at Elon Musk's Terafab initiative. On April 7th, Intel officially joined forces with SpaceX, Tesla, and xAI to move forward with a $25 billion manufacturing project in Texas. For Intel Foundry, Musk is the anchor client they've been waiting for. The goal of Terafab is to achieve 1 terawatt of compute power, enough to support a global fleet of autonomous vehicles and humanoid robots. This project will utilize Intel's 18A 2nm class process. In the foundry business, yield is king. Without massive orders to feed the data loop, a process node never matures. Musk's demand for radical chip refactoring is forcing Intel to accelerate its design and packaging leaps. While analysts at Morgan Stanley warn of the staggering capital intensity, with some estimates suggesting up to $5 trillion for 1 terawatt capacity, this partnership moves Intel from a laboratory curiosity to a high-scale industrial reality. Is Intel the new alpha or a value trap? Intel is undergoing a systematic revaluation, but the beta risk remains significant. While the 18A process is showing a yield improvement of 7 to 8% per month, Intel is currently operating with zero buffer inventory. If yields stall at the 60% mark, while TSMC sits comfortably at 80%, Intel's high-profile clients will rotate back to the incumbent without hesitation. The current rally is a vote of confidence in U.S. silicon sovereignty and the CPU AI spillover. Google, NVIDIA, and Tesla have given Intel a lifeline and a proving ground. However, Intel's transition from a backup plan to a primary provider depends entirely on 18A's performance in the next 18 months. Is Intel's doubling a return of the king, or is the price already reflecting a perfection that hasn't been achieved yet? Let me know your thoughts in the comments down below. Thanks for joining me today. If you found this video helpful, remember to subscribe to TradingKey, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.